One of the most important aspects of a successful business is its tax structure. Does it make sense to file as a corporation or an LLC? Consult a tax professional if you need more information when making this decision. At first glance, it may be hard to imagine that there's much of a difference between these two business structures. On tax day, however, the differences are stark. Corporations are their own tax entities and are required by law to pay their own income taxes. Income taxes on business profits are due at tax time, whether the business distributed the profits to the partners or not. LLCs resemble a sole proprietorship or partnership, and stipulations for paying taxes vary by the number of owners of the LLC. Different from a corporation, LLCs aren't required to pay their own taxes, so they don't file a separate tax return. The IRS applies many of the same rules to single-owner LLCs as they do to sole proprietorships to simplify taxes. Filing a tax return for a single-owner LLC is akin to a sole proprietorship. Its profits and losses are reported on the owner's personal income tax return. Single-owner LLC business income and expenses are included on your personal Schedule C form, where self-employment income is reported. Multi-owner LLCs are jointly responsible for taxes on the business's income, so each owner reports their lawful share of profits on their individual tax returns. This is agreed upon and included in the LLC's operating arrangement when the business is first being established. Multi-owner LLCs may opt to be taxed as a corporation, but if not specifically requested, it will be taxed as a partnership. A separate tax return for the business doesn't need to be filed because each owner includes his or her share of the business's profits on personal tax forms. If owners of the LLC elect to be taxed as a corporation, the business may pay its own taxes. All LLCs must collect sales tax on products throughout the year as required by local and state tax regulations. They're obligated to then distribute these collected taxes according to the local requirements of the states they do business in. State taxes must also be paid by LLCs. State taxes are collected on personal tax returns like income tax, unless the LLC has chosen to be taxed as a corporation. Some states assess an additional tax on income earned through a business structured as an LLC, while others charge a flat rate that's unrelated to your business income. Become familiar with the local tax code of all locations in which you conduct your business. Remember, filing a tax return as the sole owner of an LLC only calls for the same forms you will be filing for your personal taxes. Remember, filing a tax return as the sole owner of an LLC only calls for the same forms you will be filing your personal taxes on. Business information will be included on this form, as well as the Schedule C. Just as it is with partnerships, multi-owner LLCs need to use the Form 1065 to file their business tax return. This helps the IRS verify that each owner is accurately reporting their income information. A Schedule K-1, which needs to be included in the return with the Form 1065, shows the division of business income, credits, and deductions for each owner. LLCs that opt to file as a corporation will use Form 1120 for their business tax return. This introduction to filing your LLC's tax return can get you started, but you may have more questions. Filing business taxes can get complicated and time-consuming, especially if you're new at it. Consider hiring a tax professional to help you establish a record-keeping system throughout the year that will make tax time less stressful, as well as help you be sure you're taking advantage of the deductions that you're entitled to. If you're wondering what those deductions may be, check out our blog where we discuss 9 deductions that every self-employed taxpayer should consider.